Okay, so everyone, welcome back, and hope everybody had a good weekend. So we only got a few more meetings, including this one, and so it looks like we have this meeting, and we only have three more meetings. So this meeting, week 15 and week 16, and then you'll just have your take-home final exam. And once you get that, that's it. So we're closing down. We got two more chapters. I want to do one more like exam review. We'll do some practice questions our last meeting, so we've caught up. We've got plenty of time. So this meeting today we'll do chapter 14. Is it week 14? We're doing Look at that. So we're doing chapter 14 in week 14. We're doing chapter 15 in week 15, and then in week 16 we'll do the the final exam review. And the final exam is just think of it as another exam, so it's worth the same as the two midterms. So all three exams are the same, 15%. And so just it won't be much longer than one of the exams. And I think compared to I think the second midterm and the stuff from the second portion of the classes with the game theory and kind of the profit maxes and especially the trade model, the gains from trade, that's probably the hardest stuff. So I think the worst is behind us. But we still have still got to do the take home exam. So yeah, that's kind of where we're at. So let's do today chapter 14. So we're going to do some intro to money and banking and some financial economics. And then we'll finish up with monetary policy next week, chapter 15. All right, just note that the homework assignment from chapters 12 and 13 is due today, so you can post that when you get a chance. Okay, so we only have one chapter. It's a little long, but compared to doing two chapters, I think it'll be a little quicker. But we got to do chapter 14 today. Okay, so you can open up the chapter 14 study guide with notes and solutions. You can open up the chapter 14 PowerPoint, and we'll get to this later, but you can open up the chapter 14 homework. Nope, that's not it. Right there. Okay, so we got all the stuff from chapter 14 we're going to cover today. Okay, so this is going to be kind of a nice again, this is money banking and financial econ. We're only going to cover the surface of it. So this is a whole other side field of economics, financial economics, money and banking. You can take numerous classes and have numerous readings and literature on this topic. So if you're interested in it, you can, I mean, you can take many more classes on it. I can point out much more reading you can do, but we'll just cover the surface today. But this is a whole kind of like game theory. There's a whole, you know, rabbit hole of stuff you can go down for financial economics, and some economists just focus on this stuff. So it's a popular field, but we're only going to cover the basics of it and get us enough information and familiar with it to do so we can get to fiscal policy next week and talk about the Federal Reserve a little bit this week. Okay, so chapter 14, it's a long chapter if you have the textbook. It's a good, I mean, it's a pretty informative chapter, but I think it's one of the longer ones, if not the longest, if you have the textbook and are doing the reading. So money banking and financial institutions. So first, let's start. So basically, we got a bunch of key concepts and definitions in this chapter. So the first thing is going to be the three functions of money on slide 2. Okay, so these are the three functions of money. Number one, money is used as a medium of exchange. It's used to buy and sell goods. Number two, it's a unit of account, so goods are valued and stored in dollars. And it's a store of value, which means that some wealth, it's all you can think of it as like a financial asset as well. So it's also some type of investment, which pays little interest, but it's very risk-free. So it's a store of value. It's a way to hold some of your wealth. You can value things in dollars, so you know how much things cost. And most importantly, probably the most important of all these functions is it's a medium of exchange. And so currency, or in particular for the U.S. dollars, you can always use them. You can always you know that dollars are always going to be accepted, and you can use them as payment. So most important factor is that U.S. dollars are always considered and accepted as a medium of exchange. I mean, so you can try to go rogue and just buy things with Bitcoin, like some people like to, but you're gonna find that some things don't take Bitcoin, and crazy things happen to Bitcoin. So it's become much of a speculative asset, which is and it also become more popular because some big companies are taking it and issuing it, like Tesla, but it's not universally accepted yet. Probably will never be, but it's still uh, it's Bitcoin and things like that, cryptocurrencies, they're still not insured by the federal government or the Federal Reserve, whereas money is. So you can always know that U.S. dollars will be taken and can be used to buy and sell goods. Okay, so I've also put in, because there's a lot of terms if you read the chapter, just kind of to get us into financial econ and money and banking. There's a lot of terms. I tried to define the ones that I thought were most important, and in the study guide here, if you see the words that are highlighted yellow, those are the terms I tried to apply another definition down here. So liquidity, I have another section down here for definitions for this chapter, only because there were lots of definitions. So liquidity is defined more down here, and there's a link to some of these things as well. But what liquidity is it's essentially how quickly an asset can be converted into cash. And so the more liquid something is, the easier or faster it can be converted into cash or currency. So here we go. How easily an asset can be converted into cash. So assets like stocks and bonds are very liquid since they can be converted to cash within days. But larger assets like property, plants, equipment are not easily converted to cash. You got to find a seller. You got to go through periods of inspections, things like that. So checking accounts are very liquid because you can go to the ATM right now and take out money. But if you have land or something like that and have to sell it, it might take months or weeks to liquidate it, making it less liquid. So the most liquid asset, just by definition, is currency or cash. And the ease in which you can turn other assets into cash makes them more liquid. And so, just in general, I think investors or just consumers prefer liquidity. Now, the thing is that usually the less liquid something is, the bigger the chance that you'll earn a bigger return because it's there's liquidity and interest rates are not 100% correlated, but I think in general people prefer things that are liquid. But to get to invest in houses or other or land or property or stuff like that, or longer term bonds, you have to give up liquidity to get possibly some return. And so there's kind of a trade-off there between risk and liquidity. But just general terms, liquidity is how fast or how easy you can convert something to cash. So the things are cash is obviously liquid. Checking accounts are liquid. Savings accounts. So things that you can get cash right away or quickly, more liquid. Okay. Now we have two important definitions here of the money supply. So the first one being M1 and the second one being M2. Now, I'll show you what these things mean. M1 is the most liquid definition of money on slide 3, and I have I have a link to the data and I actually pulled it up, and you're going to see that these two things are very um, we're seeing very strange behaviors in the data given the last year or so, and I'll show you that exactly. So first, M1 on slide 3. Okay, so M1 is the most liquid definition of money. So all M1 is currency. All right, all the dollar bills and $20, all the paper notes and all the coins, and then most importantly, all the checking account money, all the checkable deposits. So all the money, if you add up all the money in the whole US, all the paper notes and all the coins, and everything in checking accounts, that makes up M1. So that's it. Okay, so this is the broadest or the most liquid definition of money, where we're looking at the money supply. It's just currency and checkable deposits, which is essentially money in checking accounts. Okay, and this includes any bank or institution that offers checkable deposits. So the biggest one is commercial banks, like Bank of America or Wells Fargo. You can also get a checking account at a savings or loan institution. You can also get a checking account at a mutual savings bank, or you can also use credit. So this is the biggest component of checking accounts, but a lot of other customers use different types of other institutions, such as savings and loan institutions, credit unions, because they have different features. Some are tied to different demographics. Like there's types of banks that are catered to military veterans, types of banks that are catered to the older generation. So just based on your banking profile, you might want to you might be exploring different banks. But the point is that to get uh, to get a measure of M1, we want to get all the checking accounts and all the currency. So if you sum up all the checking account money in all of these accounts, that accounts for this. And then if you add the currency, those two things together are M1. Okay, so this is just the most liquid definition of money, also called M1. Okay, so let me show you. So I put a link here to the M1 data. I clicked on it earlier and it looks like it's a little outdated, but I found the more recent one. I'm not sure why they switched to a different series. But if you click on this, it's going to take you to a page that was discontinued just a few months ago. There's a more updated version. If you just search for M1, you'll find in the Fred data this one. So if you just go to Fred data and search for M1, you'll find it pretty easily. And this is it. So you're going to see here that crazy things are happening when you're looking at the M1 money stock. So you know what M1 is now. And this is historical M1 in the US from 1975 to now, monthly. And so this is billions of dollars. So you can see the kind of the growth rate over time of more M1. But look what's happened since last March. Okay, so this is just last March. So in last March we had about 4,000 billion. Okay, now look what's just in less than a year. Or this big jump occurred in a few months. Now we're up to like almost 20. So M1 has multiplied by 5 in the last year. That's what you've seen here. So there's a lot more money in checking accounts, and there's a lot more people. I mean, probably most of this is the checking account money, not so much of it probably the actual currency. Although that's a portion, but there's just a shocking number or shocking amount of growth in what's in the M1 money stock, and you can see that here. So a lot of this has to do with the fact that which I'll explain next time when we talk about liquidity traps. But interest rates are super low, which means that number one, you're gonna get a lower return on other financial assets, and so if you're gonna get a low return on uh, other assets, you might as well hold your money as cash. And also, if investors think that the return on bonds and other investments is going to go up in the future or the near future, which we do, or which I think they do, they're going to hold that money as cash and wait till those interest rates go up. So there's there's a there's a bit of a unsettled territory here with what's going on with the M1 money stock, where I mean, look at it for the last for what is this 25 plus 45 years. It went from this, you know, 271 billion to about 4,000 billion, and then in the last year, it's just it's skyrocketed. So there's this is a real issue we're seeing that for the like it's not even close that so much more money is being held in checking accounts and as M1. So look at that jump, and that's yeah. So again, this is probably, I mean, I'm not sure why, or well, kind of sure, but the the jump is due to really low interest rates and the fact that there was all those loans given out. And so any of those loans that were given out during the last year, those go into your checking account and those add to the M1 money stock. Okay, so we'll come back to this. This is an important feature, but I think there's going to be some uh, lasting effects of this that we're probably not prepared for. Okay, so I showed you M1. Now let's show you M2 on slide 4. Okay, so M2 is M1 plus near money. So these are things that are pretty liquid, but not quite as liquid as currency and cash and checking accounts. So M2 is M1 plus near money. So it's M1 plus savings deposits, including money market deposit accounts, small time deposits, which are like kind of a version of savings accounts, and money market mutual funds. So these are all things which are essentially, I mean, uh, essentially what M2 is it's M1 plus savings, money and savings accounts, and that's really what this is. So M1 is just checking accounts, checking account money and currency. M2 is essentially M1 plus whatever's in savings accounts. So there's a lot more in savings accounts because it pays a little more interest, but this savings accounts or savings deposits are a little bit less liquid because you're incentivized to keep your money in the savings account because it pays more interest and there might be like a penalty for taking money out too much. Okay, so most of the super liquid things are just checking accounts, but M2 is M1 plus near monies. And near monies are basically all versions of savings accounts. Okay, and I also made a link to M2. Let's look at that. This one's outdated too, but yeah, this one's discontinued. Not sure why, but you can find the updated one, which is this one. And just in general, M2 is a lot. It's a lot more money when you include the money in savings accounts. And liquid, it's not quite as a drastic increase, but it's still pretty remarkable or pretty surprising what's happened to the M2 money stock. So we've gone from this is the same time period, or this is 1981 to now, and so from 1981 or so, or 1980 to last February, last March. Okay, you kind of see that steady growth, and then look what's happened in the last year, where there's just there. So looking at both of these metrics, there's just a ton more money in checking accounts and savings accounts. So just so much money has been created that's gone into checking and savings accounts that there's so much more liquidity in the economy. So this part of this is because of all the loans. Part of this is because of the return and all the interest rates and returns and other assets are super low. So why buy those assets if you can just keep it as currency? But it's pretty surprising what's happened to these metrics because uh, I've taught this class for a number of years, and it's only since the last year that this this crazy stuff has happened. Okay, so normally I would show this graph and it kind of goes like this, but here's the big change that's happened last time, and especially you can especially see it with the M1 right there. Okay, so we learned about M1, which is currency plus checkable deposits. We learned about M2, which is M1 plus near monies. And you can look at the data and double check it, but in terms of volt definitions, there's a ton amount, if that's a word. There's a just a shocking amount of new money in the economy that's been created in the last year. And so the amount of money in checking accounts and savings accounts has, as I just showed you, essentially skyrocketed in the last year. Okay, let's talk about the Federal Reserve. Okay, so the Federal Reserve is the central bank of the U.S., and we got some slides 8 to 13 to talk about that. Okay, so the Federal Reserve is the central bank of the United States. All right, there's 12 Federal Reserve banks, and they kind of operate as the region in which they're assigned. And so they're central banks. They also operate as quasi-public banks, and they're also just they're banks as well as Federal Reserve banks. So you can do normal banking there. The Federal Reserve structure kind of looks like this. So you have the 12 Federal Reserve banks, you have the Board of Governors. The Federal Open Market Committee decides what they want to try to do with interest rates and the money supply. And that we'll talk more about what happens from the Federal Open Market Committee when we talk about monetary policy next week. Okay, so the 12 big banks, they oversee the commercial banks and the thrifts in their region, and the public, they bank at either commercial banks or the thrift. Okay, and so thrifts include savings and loan institutions, mutual savings banks or credit unions. And I put a little link. Uh, I put a link right here for thrifts because I wanted to just include a definition. And if you click on that, it'll take you here. And so there's a little less little description on thrifts in contrast to regular banks or commercial banks. But the main difference is you can do your banking at thrifts. You can get checking and savings accounts. But the big difference here is that thrifts specialize in mortgages and real estate lending. And so if you're taking out a loan or doing something with real estate or trying to get a home loan, you're most likely going to go to a thrift. And so that's the big difference. So you can do normal banking at both things, but commercial banks are more uh, interested in the essentially their corporate profits, but you can do your banking there too. And thrifts are more, I guess, connected and associated with real estate lending. Okay, so back to this. All right, so we see that there's board of governors, there's an open market committee, and there's the 12 big banks that oversee these banks in their region. Now, if you look at the map on slide 10, okay, you can see here that this is a map of the whole US, and each big bank that you see oversees the area in their color. So, like Minneapolis oversees these states, uh, Kansas City Central Bank oversees these states, and the San Francisco Federal Reserve Bank oversees all this stuff on the West Coast, and including Hawaii and Alaska. So the main bank is shown in the city, and that bank in each of these 12 regions oversees the banks in their region. Okay, so we are under the region of the San Francisco Federal Reserve Bank. Okay, so the Federal Reserve Open Market Committee, they are responsible for monetary policy, which we're going to talk about next time. That's the main point, the main chapter of our last chapter 15. Okay, and they conduct open market operations, which again we're going to talk about next week, but that's essentially buying or selling big scale government bonds, all right, which they've done a lot of lately. Okay, and this consists of uh, all the commercial banks and thrifts that are under each of the in each of the regions. Okay, so this is kind of the breakdown of the open market committee. So what does the Fed do? The Federal Reserve, it does a lot of things, but these are some of the central functions of the central bank of the United States. It issues currency, like it actually prints money. It sets the reserve requirements, which we're going to talk about a little bit later, which are essentially how much of the bank's liabilities they can actually lend out and how much they have to keep on reserve. Okay, the Federal Reserve lends money to banks, right, at a certain interest rate. They collect all the checks that you write in cash. They act as a fiscal agent for the U.S. government, which means that they buy and sell government bonds. Okay, they supervise banks in the region and they control the money supply. All right, and so the Federal Reserve is a big part responsible for what's happened with the money supply, which is that the money supply has gone up by a ton in the last year. Okay, and so note that the Federal Reserve is essentially independent from the Congress or the federal government, and so it was established as an independent agency, and the idea was to protect the Fed from political pressures, uh, which enables the Fed to take actions to increase or decrease interest rates in order to halt or stem inflation or encourage economic growth. But technically, the Fed is a separate agency from the federal government, um, and so it's not the. I mean, obviously they work together and they talk about things, but the president can't just tell the Federal Reserve what to do, and vice versa. So they're separate things. They obviously work together, but the Fed is technically not part of the U.S. government. All right, so now we got a few slides on the financial crisis from the last recession of 2007 2008, which was a housing crisis and mortgage-backed security crisis. So we're going to talk a little bit about again this is a whole nother area that you can deep dive into. There's books, there's all kinds of stuff you can read in this if you haven't read it already, but we'll just cover the surface. It kind of comes in here. Just want to highlight some of the main features of the financial crisis on slides 5 to 18, but we won't spend too much time on it. But um, there's a lot more literature and places you can go for this area, and I can point you in the right direction if you're interested. But I just at least want to cover the basics here. So we know that there was a previous recession after 2007, 2008, and let's talk a little bit about that right now. Okay, so slides 15 to 18. All right, so we just got there's a nice little section in your textbook on this, and we only got 4 slides. We're not going to spend a whole lot of time on it, but it is a new and interesting topic. Maybe not as new as interesting as what's happening now, but um, before the pandemic crisis, if you want to call it that, this was the most recent crisis that economists were looking at. But uh, things have changed, and we've kind of gotten to another crisis. So, what happened to cause this crisis in 2007, 2008? So, this was a mortgage default crisis. And I'll just try to cover the basics, but essentially, the crisis occurred when we started issuing these mortgage-backed securities, which were financial assets that acted as bonds, and investors would buy the mortgage-backed security. So it's a bond secured by the mortgage, and they would get their bond payment when the homeowner paid the mortgage. And so uh, the homes essentially, or the mortgages specifically, the mortgage payments were the payments to the investor or the holder of the asset. And so those assets that paid the holder the mortgages were very much in demand and very much used a lot during that time. And the problem was that when there was a mortgage crisis, a mortgage default crisis, when a large number of homeowners stopped paying their loans, that meant that number one, the homes were going under, were being repossessed, and number two, the owners of the mortgage or the owners of the mortgage-backed security didn't get their bond payment, and so there was a crisis on both ends. So the houses went under, the investors didn't get their money, and there was, that's the problem. So the design of this mortgage-backed security, which we'll talk about a little bit more, was that a security or bond is a fixed payment investment. So you buy the bond, or you buy the security, or you buy the mortgage-backed security, and by buying it, you get a certain payment every year until the bond matures. That's exactly what happened with the mortgages. The investors bought the mortgage, and they got the payment from the homeowner when the homeowner paid the mortgage. Now the problem was that homeowners, a lot of them, stopped paying the mortgage, which meant that the investor or the asset holder didn't get their payment. So that's the problem. Okay, so we had governments. So what were the causes? Many causes. Um, Government programs that encouraged home ownership, which meant that interest rates were pushed low, and that caused home mortgage rates to be low. They're, I mean, they're much lower now, but that was part of the problem then. But okay, declining real estate values once people stopped paying their mortgages, and then these bad incentives provided by these mortgage-backed security bonds, which when they got riskier and riskier, they started to crumble when the homeowner stopped paying their mortgage. Uh, yes, that's exactly right. It is interesting because, right, it seems like, yeah, it's definitely interesting, especially after the fact when you can point fingers. But yeah, it's interesting because now we can kind of study it, but then uh, you know when it was occurring, not so much. But yeah, so right, it seemed like we didn't really know what to do about it, and that just we kind of saw the crisis coming when it did. Um, so what is securitization? So this is the process of slicing up and bundling groups of loans into securities. And so this the a bigger problem was that a lot of these mortgage-backed securities or assets were bundled together and then resold and resold and resold. And so investors didn't even know what they were buying or selling. They just knew that that asset was worth more. So eventually, we didn't even know what was in these bundles of investments, and they got riskier and riskier. And once the risky ones started to default, the whole system kind of started crumbling. Right. So as loans defaulted, the system collapsed, and underwater homeowners abandoned home mortgages, which meant that the people that owned the securitized asset didn't get their payment, and so everybody loses. Okay, so we had failures and near failures of financial firms. A lot of big banks went under, and some big ones came close. Countrywide home loans, I think they went under. Washington Mutual got close. Wachovia got closer, went under. And so a lot of these big mortgage issuing firms or mortgage issuing banks either failed or went close to failing. And there was a big government response called the Troubled Asset Relief Program, or the acronym TARP, which essentially allocated 700 billion to make emergency loans to some of those banks that were going to fail. And the idea was that if those banks do fail, the whole financial system and everyone that has uh, money or assets with them is also going to be worse off. So that was why were they saved the ones they could. Yeah. Okay. So there's a few more terms we can cover here, but yeah, I think that's the basis or the kind of the at least the introductory story to what happened to cause the financial crisis, where you had this asset called a mortgage-backed security that became popular and popular. Those assets or those investors were paid with the mortgage payments. Mortgage payments stopped coming in, and then everything collapsed. So there's a whole other literature in this area. One thing I always point out is that if anyone's uh, either read or seen the Big Short, okay, it's a novel by Michael Lewis, also a book. I mean, also a movie. Um, and I think both versions, the book and the movie, do a pretty good job. Or I mean, not too technical, but they do a good job of highlighting some of the key players in this and what went on here. And so, if you haven't read that book or seen that movie, I'd recommend either. And it's a pretty good coverage of different players and different sides of what kind of happened during this crisis. And so I'd highly recommend that if you haven't seen that or read that. Okay. So I talked about mortgage-backed securities, but let's define them. Um, okay. So a mortgage-backed security is an investment similar to a bond. So a bond's a security, and so a bond or a security is just a type of investment. You buy it. Okay. Again, it pays you a fixed payment every year until it matures, and once it matures, you cash it out for the coupon value that you bought it for. So if you've ever had a government bond or any type of bond, you know how it works. You get a payment every year or every month, whatever, however it's specified, and then once it stops giving you the payments, once it matures, you cash it out. Okay. Now, the thing is that homes essentially can work like bonds or securities, which is what happened here. So it's a bond that's made up of a bundle of home loans bought from banks that issued them. So the investors that buy the mortgage-backed security receive the payments similar to bond coupon payments. So it works exactly the same. Is instead of getting your bond payment, you get the bond payment as a mortgage payment. So the mortgage payment is the bond payment. Okay, so it's a type of asset-backed security because the security is backed by the asset, which is the home. And like it says here, it became glaringly obvious during the subprime mortgage meltdown in 2007, 2008. A mortgage-backed security is only as sound as the mortgages that back it up. So the reason why uh, U.S. government bonds are so secure or popular, even though they pay low interest, is that they're never going to default. So the U.S. government, as far as I know, is always going to pay you when you buy a bond from them. They're always going to give you the payment, right? The problem with this type of security is that if the homeowner stops paying the loan, you don't get the payment. So they became riskier and riskier, in this subprime term just means that mortgages were being given to less and less credit-worthy home investors. Okay, and so remember I showed you this from last time. Let's see if I can find it again. Uh, okay, so I think I pulled this up last time, but here's the S&P um, Case-Shiller U.S. National Home Price Index. Okay, which was updated in February. You can see that. So here's where you can see what happened during the financial crisis. Okay, here's the price of houses, and then once all those homeowners stopped paying the mortgage and there was the crisis, okay, the prices went down. Here's the recession. Now the prices have grown beyond that point by far, and especially since last March. So we have another uh, I guess I want to say increase in the value of the average home price. Now it's a little bit different because, well, we know now what happened here. There was the mortgage-backed security crisis. Now the bubble burst, and so the difference here is that with this really high home price value now, with the prices going up, it's not the same. We're definitely not gonna have the same crisis because first of all, the mortgage-backed security thing has been handled. And second of all, a lot of these houses are just being bought with cash. And so it kind of seems like this is the actual value of the homes right now, whereas back then they were way overvalued. Uh, Homeowners were getting loans that were way beyond their what they should get as a mortgage, and these mortgage or these loan options would essentially give them like no interest right away and then start increasing. And so they were designed to get people in homes initially, but eventually, if they couldn't pay their high mortgage loans or high mortgage rates, then that was going to crash. The difference is now, it's not that this home value price is because people are buying homes they can't afford. It's that it's that homeowners are willing to pay more in many times cash. So I don't think we're going to have the same type of crisis here because it almost seems like you'll hear stories of people just like you can't you all these houses are going before they even get to the appraisal. Like people just pay cash or write a check, and so that wasn't happening back then. This was because there was houses were being incorrectly loaned and priced. I'm not so sure that's a problem now. So I don't know that we're gonna have. I'm almost positive we're not gonna have the same type of uh, drop in home prices that we had back then. It doesn't mean they're gonna go like keep going up like this, but this problem is not gonna happen again. Okay, where are we? So I put a term here called moral hazard. All right, let's define that. So moral hazard is the idea that a party protected in some way from risk will act differently than if they didn't have protection. And so there's a little description here, but the idea that applies to the financial crisis was that a lot of the big banks, or a lot of people in the whole home loan industry, were acting more risky than they would otherwise have if they didn't think that there would be some kind of bailout. And so a lot of the big banks did more riskier things than they probably should have because they knew there was a potential for a bailout, which there was. And so the concept of moral hazard in financial econ is the fact that if you're going to get if you're not going to be uh, liable for all of the risk if you fail, but gain all the profits if you win, then there's a moral hazard because you're not fully being expected to reap the downfalls if it doesn't work out. But if everything works out, you get to keep all the profits. So that's moral hazard when someone or a company acts riskier than they would otherwise if they didn't have some type of protection. Okay. Um, Next, we are going to talk about the fractional reserve banking system. So there's a lot in this chapter. So first, we just talked about what what money is, the definitions of M1 liquidity, and what that data looks like. Then we talked a little bit about the Federal Reserve. Then we talked a little bit about the financial crisis and mortgage-backed securities. Now we're going to talk about the actual banking system and how money is created by bank lending. Okay, so this chapter I think can be kind of broken into almost three different chapters, and so there's a lot going on here, but it all has to do with money and banking and financial economics and that recent crisis. Okay, so slide 22. Let's talk a bit about the actual banking system, the fractional reserve banking system in the US and what we're working with here. So, slide 22. Okay, so all right, so the US operates under a fractional reserve banking system. And this means that only a fraction of the money in checking accounts and so on is backed by actual money. And what the fractional reserve system essentially means, which is that if everyone went to their banks and said, I need to take out my money for cash, there wouldn't be enough money to do that. So we don't have enough actual currency to cover all of the money in checking and savings accounts. Only a fraction of it. Now, it's not a problem because the demand for actual bills and coins is never going to be high enough. It's too risky. But just know that there's not enough actual bills and currency to cover all the money in checking and savings accounts. Okay, so this idea kind of started, there's a little history here, which is kind of interesting. Um, if you're familiar with the old gold standard where we had goldsmiths, so what happened is back in the days before we had Twitter and everything, um, currency or the dollar was backed by gold, which meant that then the amount of money was determined by how much gold was in reserve. And so your money was backed, there was the gold standard, which meant that money was backed by gold. Now, what, so a lot of people just had their money as gold. Now, the problem was gold is heavy. And back in the days, if you're driving around the old west or whatever, or you have your gold as your asset, uh, it's heavy. It can be stolen. You have to keep track of it. And so what happened is this occupation arose called the goldsmith, and the goldsmith they would store the gold for them and give them a receipt saying you have this much gold in the vault, and here's an IOU. So they would hold it for him for a fee, and the receipt for the gold was just as good as the gold, and he didn't have to carry the gold. Now, what happened is instead of using gold as payments, like instead of taking a brick of gold and taking it to the bar, taking a brick of gold and buying a house or whatever, you could just use the receipt that said you have this much gold and use that as money. All right, and then eventually, when the goldsmiths realized, and which became banks, that the public preferred the actual notes and receipts instead of the gold itself, they just started giving out more receipts that weren't backed by actual gold. And so this was the process by which there were more receipts than gold, and now we have a process by which there's more uh, money in checking and savings accounts than actual money that can back them. So the idea here is that banks can create money through lending, and banks are subject to panics if everyone were to take their if we lost trust in the whole banking sector and we decided to take all our money out of the checking and savings accounts, that'd be a problem because there wouldn't be enough. But as we've seen here, and kind of I showed you in the data, banks can create money through lending. So all of this, okay, all of this crazy increase in the M1, which you can think of as checking account money, was essentially created by lending. So this is due to the fact that more banks, more loan institutions, or more whatever are just giving out more loans. So all of this money was created by lending. So that's what's going on here is just the amount of money that was lent out in the last year is more than we've ever seen before by far. Okay, how about the next term, which is the required reserve ratio? So this required reserve ratio, I define it down here, but it's essentially the amount that banks have to keep on reserve and not lend out. So banks um, are, you know, corporations that have stocks and bonds, and their goal is to generate revenue and their value for their investors. So banks are profit-making institutions. So commercial banks are the goal there is to make a profit, and they make a profit by lending. So if they lend money, they get the interest rate payments from the lenders, and so banks make money through lending. But there are requirements by the Fed that says banks can't lend out all their loans. They can only lend out a certain amount, and the rest of it they have to keep just in case some crazy stuff happens. Okay, so the reserve ratio is essentially the portion of reserve liabilities that commercial banks must hold on to rather than lend out. So if banks had no rules, they lend out all their money because that means higher profits and more interest rate payments. But they can't do that. They can only lend out what they can in excess of the reserve ratio. So like if a bank had $1 million and the reserve ratio or the reserve requirement was 1%, then they can only lend out 999,000, right? So they can only lend out in excess of what they're required to keep on reserve. So the Fed makes sure that banks have some amount just ready to go, just in case there's some kind of bank panic or some kind of issue where the banks need more liquidity, because banks are trying to balance their liquidity or their reserves, and they also want to lend out more money and get more profits. Okay, so it's determined by the central bank, which is the Federal Reserve, and commercial banks are required to hold reserve against their total reserve liabilities, their deposits, which can't be lent out to the bank. Okay, so this is the amount or the portion of their deposits in the banking in their accounts that they cannot lend out. So that's the idea here. Okay, so now let's talk about how this has happened, how we've created all this money by lending. So granting a loan in our definition of M1 and M2 is essentially creating money, And that's what happened there in that M1 and M2 data we saw. So, oops. Oh, is this where I went? Slide, slide 32. Okay, so there's a whole balance sheet exercise here, which we're not going to do, but just note that a single bank can only lend an amount equal to its pre-loan excess reserves. And so banks want to lend out all the money they can in excess of what they have to keep on reserve, and they'll do that. Okay, so just think of a single bank, and the idea here is that a single bank can lend only amount equal to the pre-loan excess reserve. So they lend out as much as they can, and they keep the rest in reserve. So one bank can create uh, money, put money in checking accounts up to the amount in excess of their reserves. So that's what they do. But if you look at the banking system as a whole, not just a single bank, if you look at all the banks interconnected, this is where we get kind of a multiplied effect. And we'll see that the banking system as a whole can create more than just the pre-loan excess reserves. They can, in fact, create a multiple. So if we look at slide 33 and 36, okay, we'll do a little we'll do a little exercise on the next couple of slides, where this illustrates how the banking system can create more than just a one for one of new money. So there's this thing called multiple deposit expansion. And let's do a little exercise where let's assume that 20%, there's a 20% reserve requirement. So 20% of the banking assets cannot be lent out. All banks are loaned up, which means that they're going to lend out 80% of their assets. Okay, so they're lending all of their excess reserves, all 80% of it. And let's assume that there's $100 bill is found and it's deposited into some bank. And let's show how that $100 in excess or in new money. So just in terms of the one bank, we'll see that the $100 goes in and the bank keeps $20, 20%, and lends out the other 80. So that's $80 of new money created by the one bank. But once we look at the effect on all the other banks in the banking sector, we can create much more than that initial 80. Okay, so here we go. This is a good slide. It shows you very clearly kind of how some new money by one bank creates a multiple if you look at the other banks. So here's the idea. So this is here's the banks. So let's start here. Bank A. Oop, okay, so the customer has the $100. They find $100 and they deposit the $100 into Bank A. Now the reserve ratio is 20%, which means that Bank A has to keep $20 and they're going to lend out the other 80. Okay, so just by lending, that's $80 of new money. But that's just from Bank A. Now what's going to happen is that the customer who gets the $80 lending from Bank A is going to go spend it, and they're going to they're going to go out to dinner, and they're going to spend $80 on dinner, and then the restaurant will deposit their $80 into Bank B. Okay, then Bank B has to keep $16, 20%. They can lend out the other 64. Okay, and then Bank B is going to lend out the 64, and then this customer is going to take the $64 and buy I don't know, a video game, and then the video game company will deposit the $64 in their bank, Bank C, and to see how this trickle down effect. So each time there's a little bit less created, but it keeps going more and more where the bank lends out again and the customer buys something, and the bank lends out again and the customer buys something, and we get, if you did the math here, you would see that with the reserve ratio of 20%, with initial excess reserves of 80, the total potential creation in the whole banking system is 400. So there's a potential for this $80 in new money. If you trickle down through the whole banking system, that can create up to $400 of new money. Okay, so that do we see what's going on here? Like how I'm trying to illustrate how, first of all, how just one bank can create $80 by lending out excess reserves, and then also how the whole banking system can create a multiple of that 80 by trickle down effects to the other banks. Okay, and that's going to set up the money multiplier or the monetary multiplier. So what's going on in this slide 36? The do we get the idea of what's of the illustration for the multiple deposit creation? Okay, is it somewhat clear of what's going on here? Okay, great. Um, so the point that I've highlighted here in bold is that although each individual bank can only safely lend an amount equal to its excess reserves, the commercial banking sector as a whole can lend by a multiple of its collective excess reserves. So that in that example, the one bank could only lend the 80, but the banking sector as a whole could lend a multiple of that 80, and that's the multiplier. So the monetary multiplier, or little m, on the last couple slides here, okay, so the monetary multiplier is 1 divided by the reserve ratio. That's it. So the amount of money that possibly created is directly determined by the reserve ratio. So last time we had our reserve ratio was 20% or 0.2 in decimal terms. If you take 1 divided by 0.2, what do you get? You get 5. So the monetary multiplier was 5, which means that the initial 80, multiply that by the multiplier of 5, and that's how we get the 400. So that's why the money multiplier is multiplied by the initial new money, which is 80. So 80 times 5 is a potential of 400. Okay, so what you see in this simple equation is that if the reserve ratio goes up, if more money cannot be lent out, then less money can be created. But if the reserve ratio goes down, right, banks are going to lend out more money and there's more money creating potential. So the Federal Reserve can directly get more money into the banking system by lowering the reserve ratio and vice versa. Okay, so the monetary multiplier is just the maximum amount of new money created by a single dollar of excess reserves. So in this example here, the maximum amount that could be created with the initial 80 was 400. And if you multiply 80 by 5, that's how we get the 400. Okay, so higher R, lower M, because if the reserve ratio is higher, banks can lend out less and more money is lent out. But it's also reversible where making money creates loans, like has happened, but if everybody pays off their loans, then that eliminates money. Okay, so again, all of this new money essentially has been created by lending. Okay, So there are a lot of terms there. So make sure you know the functions of money, uh, what M1 and M2 are, and how what the crazy things that have happened in the data in the last year. Okay, and how M1 is the most liquid definition, which is currency and checkable deposits, and M2 is M1 plus, essentially savings deposits, so savings institutions. And we talked about the Federal Reserve, which is the central bank of the U.S. A little bit about the mortgage crisis and the financial crisis of 2007, 2008, which was caused by this mortgage-backed security collapse and the design of that system. A little bit about the actual fractional reserve system, the reserve ratio, and how banks create money by lending, and also how one bank's excess reserve lending can lead to a multiple in the whole banking system, which is determined by the monetary multiplier. Okay, so a lot of good stuff and a lot of key terms in this chapter, and you got some optional videos, money and finance. This is a nice quick one, how banks create money, and there's another 10-minute one on the financial crisis, so you can take a look at those. I think this one's like 10 minutes, this one's just a few minutes, and this one's probably another 10 minutes, but if you get a chance, there's some good stuff there. Uh, we looked at the definitions, which are here, and there's also a link for liquidity, uh, mortgage-backed securities, moral hazard, and the reserve ratio. Okay, let's look at some examples. Okay, number one is let's assume that the following assets in millions of dollars exist in Iron Mania. We got Federal Reserve notes in circulation, 700 million, money market mutual funds, 400 million, corporate bonds, 300 million, iron ore deposits, 50 million, currency in commercial banks, 100, savings deposits, including money market deposit accounts, 140, checkable deposits, 1,500, small time deposits, 100, and then coins in circulation, 40. And those are all in millions. So what I want you, or what we're doing here is just to understand the definition of M1 and M2. So what is M1 in Iron Maiden? So M1, by definition, is just currency plus checkable deposits, right? Okay, so currency in this example is two things. So currency is all the bills, all the paper notes, and all the coins. So if you add up Federal Reserve notes in circulation, 700, plus the coins in circulation, 40, all right, that's the bills plus the coins, which gives you all the currency. And then checkable deposits is 1,500. Okay, so currency, which is bills plus coins plus checkable deposits, gives us an M1 here of 2,240 million. And then what is M2? So the definition of M2 is M1 plus savings deposits plus small denominated time deposits plus money market mutual funds. So just put in those things. We already got M1 of 2,240. Savings deposits, 140. Small denominated time deposits, 100. And then money market mutual funds, 400. So if you add those things together, you get 240 plus 140 plus 100 plus 400, which is 2,880. Okay, and so just to go through this real quick, so all the terms either go somewhere or they don't get counted. So the Federal Reserve notes in circulation, that's currency. Money market mutual funds go into M2. Corporate bonds, that's not a definition of money that has nothing to do with currency checkable deposits or M2, so that doesn't get counted. Iron ore deposits, that's some kind of mineral that has nothing to do with this. Okay, but currency and commercial banks, you don't want to count that because you already counted that from the checkable deposit side. So you don't want to count checkable deposits and money in the banks because you'd be double counting. So only count the checkable deposits, not the actual money in commercial banks. Savings deposits, that went into M2. Checkable deposits went into M1, and then small time deposits went into M2, and coins are part of currency. Okay, let's suppose Lady Gaga goes to Vegas to play poker, and at the last minute, her record company says it will reimburse her for 50% of any gambling losses that she incurs. Will Lady Gaga wager more or less as a result of reimbursement? And what economic concept does your answer illustrate? So, if she gambles or plays poker and she gets to keep any winnings, but if she loses, she gets reimbursed for 50%, then obviously she's going to wager more because if she wins big, she gets to keep it all. If she loses, she only loses half. So uh, the risk of not winning is not as high as the risk of losing because you get reimbursed for 50% if you lose, but you keep all the money you win. So she's going to wager more because of this. And this illustrates a nice little example of moral hazard because she has some insurance of losses, but gets to keep all the winnings. Okay, number three, last example is this one is a nice one. There's one in the homework. It illustrates the relationship between reserves, the reserve ratio, and the money multiplier, and et cetera. So bank customers deposit $1 million in checkable deposits in the Iron Bank of Bravos. So let's answer the following questions in response to this new $1 million in checkable deposits, and let's assume the reserve ratio is 50%. Okay, so part A is what is the maximum amount of new loans the bank can make, also called excess reserves. So if $1 million is deposited and the reserve ratio is 50%, that means the bank is going to lend out in excess of, they're going to lend out 50%. So 50% of this has to be kept in reserve. The other 50% can be lent out. So 50% of a million, 0.5 times a million is 500,000. So they're going to lend out 500,000. The other 500,000 they got to keep on reserve. So excess reserves of $1 million with the reserve ratio of 50% are 500,000. Okay, what is the size of the monetary multiplier? And remember, the monetary multiplier is just 1 divided by the reserve ratio. So M is 1 divided by the reserve ratio. If the reserve ratio is 50%, in decimal terms, that's 0.5. So 1 divided by 0.5 is 2, and we get a multiplier of 2. Okay, calculate maximum checkable deposit creation, which is just excess reserves times the multiplier, like we did in that big example with all the banks. So these are the excess reserves the bank can lend out. This is the multiplied effect of new money, so just multiply that times that, or E times N. So big D, uh, maximum checkable deposit creation is excess reserves, 500,000, times the multiplier, 2, which gives us maximum potential of $1 million. Okay, so the one bank that gets that lends out the 500,000 that can be created up to $1 million in the total banking sector. And then D, answer the questions A, B, and C on the assumption the reserve ratio is 40%. So you just note that if the reserve ratio gets lowered, there's going to be more excess reserves and a bigger multiplier. So if the reserve ratio is now 40%, the bank can now lend out 60% of the deposit. So 60%, 0.6 times a million, now they can lend out 600,000. And the new multiplier is 1 divided by the new reserve ratio, which is 40%. So 1 divided by 0.4, okay, 40% in decimal terms, is a new multiplier of 2.5. So it's a little bit higher. And then the 600,000 that can be lent out at this reserve ratio times the multiplier shows the amount of money we can create now with the different lower reserve ratio, and 600,000 of new loans from one bank times a multiplier of 2.5 means the banking system can create up to 1.5 million. All right, so nice example of how you determine excess reserves, the multiplier, and how much possible money can be created. And also, if you change the reserve ratio, if you lower it, that's a bigger multiplier, more money creating potential. And if you increase the reserve ratio, lower multiplier, less new money to be created. Okay. Okay, so any questions on any of those examples before we run through the homework assignment? All right, so I think it's a relatively short homework assignment that's due next week. So this is the chapter 14 homework assignment. So you just got one on the money supply. So you're gonna get a little description of some things and read through that just like the example we did, and just use the um, definition of M1 to calculate M1, and then use the equation for M2 to calculate M2. All right, so you're gonna just use that example, and based on this information, just calculate M1 and then calculate M2. And number two, this is like the one we just did. So you got a new $100 in checkable deposits. The reserve ratio here is 5%. So with the 5% and the new $100, calculate the max amount of new loans, calculate the monetary multiplier, and then calculate the maximum amount of new money that can be created there. And then if the reserve ratio gets dropped to 2.5%, just do the exercise again. So all the equations and all the examples you need for these two are the ones we just did, and shouldn't be too difficult there. Okay, so everyone good on what I want you to do for the two homework questions? This, I think it's a pretty short assignment, but uh, all right. I think that's what I had planned for today. And so just a reminder that the chapter 12 and 13 homework is due today. All right, so make sure you post that if you haven't done that. And the chapter 14 homework shouldn't take you too long, but that's due next Monday. All right, and then if you're doing the reading, the final chapter is chapter 15, where we're going to talk about monetary policy. Okay, so one more chapter It's a big one for monetary policy. We haven't talked about that yet, but that's coming next. And that's what we're doing next week. So chapter 12, 13 homework due today. Chapter 14 homework due next Monday. And then next Monday we'll do chapter 15, which is going to be all the basics on monetary policy. Okay, so if there aren't any further questions and no problems with the homework, so I think that's it for tonight. We'll finish a little bit early, I guess. And so thank you everyone for coming, and have a good rest of your week.
Thanks, Professor. See ya.
Thank you.
Thank you.